Well, welcome once again. Today we're talking about the 30 June quarter of 2026. Once again, I'm joined by Dr Steve Garth. Welcome, Steve.
Yeah, thank you, Rob.
Another very, very interesting quarter. Tell us a little bit about Australian markets first.
Yeah, let's start with Australia. You know, Rob, over the whole world, lots of headwinds this quarter when you think about it. You know, volatile oil prices, conflict in the Middle East, interest rates and inflation. It's been a tough quarter, and yet markets have been really resilient. In Australia, it's more a modest gain. You can see in the chart here that it's a 4% return in the quarter. Not too bad. Over the financial year, more modest, 6.1% is fairly modest for a financial year. You can see in the Australian market, it gets going and then it gets whacked by something like a bad inflation print. It gets going again and then gets whacked by bad earnings results from our top companies. But all in all, not too bad.
Yeah. Global markets, a bit more interesting, a bit more positive.
Yeah, so whatever lacking in Australia really made up for it in the global markets. Have a look at this chart. On the left-hand side, I'm showing the developed markets represented by the MSCI World Index. And you can see, man, it's up 15% for the full financial year. Now, the biggest part of that is the US, but Euro and Japan are big parts. And you can see, Rob, when you look at the other columns, that it's pretty even. In other words, all the regions are contributing. Financial year returns across all markets are anywhere between 15 and 20%. And then on the right-hand side, the emerging markets up 35% for the financial year.
So emerging markets, so tell us, very, very positive, but what's going on?
Yeah, extraordinary quarter, and this has still got to do with the AI trade. So what's been driving international markets, particularly the US, is you know, the companies we always hear about, the Magnificent Seven. But the big semiconductor chip makers are all in Taiwan and Korea. And they're the markets that have just gone crazy. You can see in the chart here that Korea up nearly 200% in Aussie dollar terms for the year. And Taiwan, well, they're a bit of a laggard. They're only up 100% in Aussie dollar terms for the quarter. So just extraordinary results. So it's all got to do with the AI trade, but instead of the big AI companies we hear about, these are the chip makers all based in Asia.
Yeah, for sure. And bonds. So interest rates, very, very topical in Australia, but also very interesting globally as well.
Yeah, that's right. So a good way to look at interest rates or expectations around interest rates are looking at bond yields. Not everybody's cup of tea, I know, Rob, but bear with me for a moment. The chart we've got here is the Australian and US 10-year government bond yields. Now, obviously they all spiked at the end of the last quarter on that huge oil increase. But when you look at Australia, that bond yields have been coming down a little bit since then. So number one, that's good for the bond returns. When yields come down, bond prices go up. Number two, it's also a reflection that inflation is moderating. So it's still sticky, but it's coming down, and therefore we expect interest rates will probably stay on hold for a little bit longer. On the US, the other hand, is a little bit more interesting. Spiked at the end of the quarter, but then they kept going up. And so there's an expectation there that perhaps the US will have to raise rates a little bit. So bond returns, pretty good. Good yields coming out of bonds now, 4 to 5%. And on expectation of interest rates, Australia, I think they'll be on hold no matter what you hear in the press. The US, I think they're going to have to raise at least once more this year.
And gold's an interesting one. It's been shooting the lights out for a few years now, and it's obviously come off, as we can see. Still positive returns from a rolling 12-month return. But having said that, that has come off recently. The reason for that, Steve?
Look, gold's a bit of a mystery one. Gold's meant to go up when there's geopolitical conflict and inflation. Well, we've got both those things, and yet the gold price is down about 14% since the start of the war. What's going on? The main reason is that bond yields are way more attractive now. Remember, gold does not pay an income.
That's right.
Where bond yields provide you that regular income. So really that's what's got to do with the fall in gold, is that other assets such as the US dollar and bonds have become more attractive to investors.
Understand. All right, well, thanks, Steve, once again for those insights. Thank you for joining us, and we'll be in touch again. Obviously, if there's any questions in relation to anything we've spoken about, pick up the phone, shoot us an email, and we'll speak to you soon. Thank you.